All right.
Great.
Brennan,
Hey,
unless you guys had anything
Johnny.
further on that. Brennan,
I got the.
hopefully you don't
What you
get run
doing?
over by a tractor. There was something happen out there,
But
right? There's
Yeah,
some
there's some
issue.
construction in the background.
Yeah,
Can
we're
hopefully you
good.
guys
We're
can't
good.
hear it.
We can't hear it. Don't worry. You're going to talk about our star of the week, AEHR Test Systems. Had a pretty sizable announcement today, at least sizable in terms of what it did to the market cap. It was up about 35-40% today.
So yeah, thanks, Ryan. Let's jump into AEHR Test Systems here. So this is our star of the week, a company which we have followed for the past few years, which is up over 40% today after a positive announcement. So the company trades under the ticker symbol AEHR on the NASDAQ, currently trading at a price of about $25 per share, market cap of about $530 million. They don't pay a dividend. And they are a provider of test solutions for testing, burning in, and stabilizing semiconductor devices in wafer level singulated die and packaged part form. And essentially, AEHR Systems AEHR's products or its systems increase the quality, reliability, safety, and security needs of semiconductors used across multiple applications. So we actually wrote a monitor report on the company in June of 2025 at a price of $11 per share. And I wrote in that report that the business possesses several positive attributes, but that it remains higher risk given the macro headwinds and that it is a contract driven business. But, we continue to monitor the company closely today. Looking at the share price, the stock is actually up 150% over the past 6 months and is up, like I said, 40% today. So let's dig into why the stock is up so substantially today in the trading session. Well, what's driving it is they announced that a major hyperscaler expanded its AI processor production capacity with additional AEHR test package level and burn-in systems, which is for 6 Sonoma ultra high power package part burn-in systems for AI burn-in testing. But they did not disclose how much the additional follow-on orders would be for or who it was specifically for. But they did indicate that they would be delivered in the next 2 quarters, Q1 and Q2 of 2026. So the stock was up significantly following this announcement. Now, looking at the financials, we can see that margins have been contracting through fiscal year of 2025, given a decline or a slight decline in revenue, and adjusted net income was actually negative in Q4 of 2025. That is for the period ended May 31st of 2025, all while the business has temporarily withdrawn guidance given these macro uncertainties. But they did announce that they expect growth in fiscal year 2026, but they do remain cautious. And as you can see here from the valuations, they remain very pricey at this point from a trailing standpoint, as it's at trading at over 160 times trailing earnings, excluding cash. They do have a net cash position on the balance sheet, and over 400 times trailing EBITDA. So very expensive, in my opinion, at this point. So to conclude here, the acquisition of Inkle Technology, which I didn't really talk about today, but I did highlight it in that monitor report for clients, which was made in August of 2024, does allow AEHR to offer a line of high power packaged part reliability burn-in test solutions for artificial intelligence or AI semiconductor manufacturers. And the announcement today that it received additional follow-on orders for 6 Sonoma ultra high powered package part burn-in systems for its lead production artificial intelligence processor customer for part burn-in is positive. And this has led the stock significantly higher, making it our star of the week. But at this point, my question is, how much does it really move the needle of the financials? As we kind of remain in the dark on this front of how significant this announcement really is. Now, the balance sheet remains healthy with net cash per share of 46 cents. Although they do continue to issue shares. This is something that I highlighted in the report. They have an at the market program. So if someone's interested in the stock, that is something to keep an eye on, is that they don't dilute too much. And again, that net cash position on the balance sheet is more from issuing shares than just generating cash flow. Right now, I do believe that the trailing valuations remain extremely pricey. Fiscal year 2025 wasn't the best given macro uncertainty and contracting margins, and management has yet to reinstate guidance for fiscal year of 2026. To me, the stock remains more speculative right now. It's high risk for high potential reward. It's really going to be interesting to see how much these recent orders move the needle, or if the news release today has led the stock to jump way ahead of its underlying fundamentals. If all of a sudden we don't see anything drastic in the fundamentals over the next few quarters, I could see the stock coming back down as quickly as it increased today. So, I would say it's tough to say right now, but regardless, the stock will likely be highly volatile and will be a name we continue to monitor, and it is our star of the week.
Yeah, it's certainly interesting company we monitor. As I understand, Air generates kind of one-time revenues off the sale of their Fox,
Correct.
XP, and Sonoma products. So that,
Yeah.
again, like you said, this makes sales lumpy since they are unpredictable, depend on customer production ramps and a number of things. Things look solid right now. We just when we have these contract driven businesses, we either need the backlog to continue to go higher and know the margin on it, and if we don't have that, and on top of that, we don't pay a massive premium for companies like that, because if the backlog turns south, you can really take a hit. So I mean, I think they are trying to add some recurring revenues this business as well, but again, we monitor it. It's good to see the jump if anybody owns it today, but we probably wanted it at a lower valuation to take some of the risk out.